Welcome to Real Estate Radio Power Investing, an informative and engaging hour discussing everything you need to know about the world of real estate investing. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate Radio Power Investing, Tom K. Wilson.
Thanks for tuning in to our Real Estate Radio Power Investing program, where we empower you with the education to maximize your investing success. We're broadcasting from our Wilson Investment Properties headquarters in Silicon Valley. I'm Tom K. Wilson, your host for this weekly program on real estate investing. If you can't make the live show, you can catch our podcast on TomWilsonProperties.com or on iTunes or on YouTube. You can also go to TomWilsonProperties.com and sign up for our newsletter on economics and real estate. It comes out weekly. Also, by doing that, you will get signed up as a part of our client base so that you can get access to our high quality and high return multifamily and commercial syndications for as little as $50,000 a share. And of course, we always welcome your questions and your input. So today we're going to talk about some details about commercial and multifam investing and leasing and other aspects of that with commercial experts Tim Tran and Helen Chong. So Tim has been a broker for many years. He's a member of CCIM. In fact, he's a chapter secretary. He's active in many charitable operations or organizations like the Rotary Club. He's got an engineering degree, like many of us who have gone from tech to over to real estate. I don't know what it is about that, but we seem to be a natural migration for us. He's been a consultant before pursuing his commercial real estate, and he has a proven track record of negotiating, managing, and closing CRE projects in both public and private sectors. He specializes in the variety of sales, purchases, joint venture activities, including office, retail, medical, apartment, hotel, motel, warehouse, mixed use, many storages, and vacant land. So that's quite a variety of experiences. Tim, welcome to the program.
Thank you. Welcome.
Yeah. How did you transition from engineering over to real estate?
It was actually a pretty easy transition. I've always loved numbers. I always like to analyze things. And as an engineer, that's what I did almost every day. And then when it came time to transition that skill set to real estate, it was pretty obvious to me.
What planted the seeds?
Just, reading different stories when I was young, looking at how real estate can really help you build wealth. As an engineer, I made pretty decent money, so I started to invest in real estate at that time. And I thought maybe one day I could use the skill sets that I learned as an engineer, as an investor, and help clients invest as well. So that's how I got started.
One of the things that has amazed me in life as I've progressed from one career to another is how transferable skill sets are. That I think a lot of people underestimate how much you can move skill sets, managing, marketing, analyzing, all of those things from one product or service over to something entirely different. Whereas many people, I think, have the concept that if they know how to write code or they know how to make a certain kind of widget or, whatever, if they're an attorney, that's really where their value and wealth is. And yet that's not the case at all, maybe.
Yeah, that's right. Even as an engineer, I always used to negotiate all the time, whether with friends or family or just whatever, right? And so that skill set obviously is also transferable, and little things like that in life that you don't really think about, it helps you in your real estate.
Yeah. Let's bring on Helen Chong as well, who's also an officer in the Northern California CCIM, which we're going to tell you what that's about here in a moment. And she's a broker of the Haylen Group. She has a degree in economics from UCLA, been in real estate since 2004, experienced mortgage broker, rehabber. That's always a place to learn a lot. Rehabbing, apartment owner, trust deed note investor, and realtor. And mother of 3 and wife of an honorable veteran who fought in Iraq 3 times.
Yes.
And, thank you for your family's service.
Thank you.
Welcome, Helen, to the program.
Thank you. Thank you for having me.
Did you start off in real estate? Are you one of the rare ones that started off?
I actually did not start it from real estate. I was an analyst at a pension consulting firm in Santa Monica for 4.5 years.
Well, that's an obvious beginning path to real estate.
Yeah, it was like about stock market, and then transitioned to real estate because when I realized in year 2000 the stock market pretty much crashed, and I started studying a lot about like different type of investments, and I felt like stock market was kind of like you're out of control. You cannot control your retirement. And I met people who were retiring around that year and pretty much lost most of their retirement funds. So I started doing research, understanding how to do real estate investments. I felt like it's something that I can actually, control, for example, how to add value to property, and that makes a difference. So I just jumped right into real estate afterwards.
It's really haven't thought about this before, but for a lot of people who would like to be an entrepreneur, of course, living in high-tech region like we do in Bay Area and Silicon Valley, the natural thought is, well, I guess that means starting up a high-tech company, but you can be an entrepreneur just to decide to flip a house, right?
Yes,
yeah, that's certainly an entrepreneur.
Yeah, absolutely.
So there are a lot of different levels. So what'd you learn from house flipping?
It was really fun. When I started, it was actually about 2007. That's when I started flipping property, and I bought property for like $30,000, and I put some money in, like $15,000 just to clean it up.
And this wasn't down in Mexico, right?
No. It is out of state because at the time I did not have money. I was like an underpaid analyst, absolute underpaid analyst. And then when I started getting to real estate, the market kind of crashed and I didn't really make a lot of money, but I really want to start investing. So I went to Midwest area and also Texas, and I bought some property. So it was REO, and I negotiated down and put some money in and then rent it back out. Basically use that buy, rehab, refinance, and then just rent it out philosophy. And it was absolutely fun. And then from there moved on to apartment buildings. Same thing, bought it for dirt cheap, $100,000 for 12 units. It was like 60% vacant, and I just remodel, just make it clean and functional, and of course safe. Rent it out, got really good cash flow from that. And from then on, it's pretty much like, in California, people ask me, how do I invest? I met with a lot of investors. I started working on helping people buy cash flow properties here in California. And then I moved up here to Northern California from Southern California about 6 years ago. And it's been fun.
Would you say there's any kind of categorical kind of difference in the market or people's attitudes or anything between Southern Cal and Northern Cal?
Definitely. I think in terms of clientele in Northern California, because I have that analytical background and I love spreadsheets. So when I connect with my clients up here, it's like as soon as I bring out that spreadsheets, they understand everything what I'm trying to say. And to me, a lot of things is very number, it's all about numbers. So in Southern California, it's a little bit different. Less engineers, of course, people are less analytical. So it's more of an emotional type of clientele down there. Mm-hmm. Yeah.
Which I think is probably more typical of the country, right?
Yes.
That's we're the ones that are kind of unique here.
I would say.
And yes. I would say that's certainly been an element that significantly contributed to my starting Wilson Investment Properties. Mm-hmm. Was that we have largely an audience of techies, and they know that I am, and they knew that I was presenting, and I could answer their technical or analytical questions, and mm-hmm. they kind of helped them to relate. So you've stayed mostly in the multifam arena, right?
Yes.
Uh-huh.
Yes.
And so Tim, you've done some multifam, but you've also migrated into non-multifam commercial, right? Our listeners, it's really easy to get confused about the vernacular in this business. Commercial really is from the root commerce, which means you make money from, revenue from, an investment in real estate. and that includes multifam, although I think a lot of people think when they say commercial, they think of it separately sometimes as the multifamily part of commerce or commercial, right? They think office buildings and retail centers and industrial and that sort of thing. But anyway, so with that long-winded introduction, what got you interested in the non-multifam part of commercial?
What got me into the non-multifamily is really what the clients want and what they look for.
Well, that's a novel idea.
Right? It's what the market dictates. And being in commercial, there's really two groups. There's the people who are buying a commercial property for investment purposes, and there's the one who are using it for their own business expansion. Okay. Right? There's really, if you boil down to it, there's really two groups.
I sometimes forget about that.
Yeah, it's really basic. So with non-multifam, it's office, retail, developers are looking at land to build, to add value, get it entitled. So things like that are really dictated by what the clients want. A lot of them are business owners. They're looking to expand. They need a warehouse for distribution. They need a office to run their sales and marketing team. So that's how we kind of branch off. In our world, commercial real estate is really all of the above. Multifamily, anything 5 units or more, office, retail, vacant land, mini storages.
Can the two of you talk a little bit about what CCIM is? Certainly a small percentage of commercial brokers, I think, have that designation, but the ones that do are highly respected for being in that space. So tell us what CCIM means.
CCIM stands for Certified Commercial Investment Manager. It is an educational organization. You have to go through quite a long list of educational classes. As a matter of fact, a lot of not just real estate brokers who would take these kind of classes, but also asset managers, even some MBA students, they take that. It's very analytical. We learn a lot of different analysis, and then you have to have a portfolio requirement. Basically, you have to complete at least either 3 deals over $30 million or 10 deals that's over $10 million. And then you pass a 6 hours exam, then you can get your destination.
Okay. And you're both not only members and been through and to have that certification, but you're both officers in the Northern California chapter. Is that right?
That's right. The reason I became an officer is when I was going through my CCIM designation process, I got an opportunity to earn some scholarship. So in my mind, I promise that I can do whatever I can to help advance the industry by giving back.
Okay, we'll be back in a little bit more on that in a moment with Tim Tran and Helen Chong. So stay with us here on Real Estate Radio Power Investing. We'll be right back.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
We have with us today in studio Tim Tran and Helen Chong, who are both experienced commercial real estate brokers and investors. Been doing it for a long time, and they often work together on deals, which is why we have them here together. And we're learning from them what they've learned about the commercial world. We were talking about before the break. We're talking about the CCIM, which they're both members and officers of. What value would you say you got from CCIM, and what would you recommend to someone else who's in the commercial real estate arena?
I think I get a lot of value out of CCIM. I think the educational part of it is one of the main components. The ability to network and reach out to a network of CCIM members around the world is also very valuable. And finally, I think the fact that they teach you how to analyze real estate from a financial perspective is really what kind of sets us apart from other non-CCIM practitioners.
We call that in the business to our listeners underwriting, and it can get get very complex, sometimes not only hundreds of cells, but thousands of cells, and you got to figure out what assumptions to put in, and that's not a simple thing to do. So evaluating whether or not you have you've got a good deal has a lot to do with how you can underwrite it, how you can analyze it, right?
That's right.
And it takes certainly a special skill set to do that. Yeah.
Yeah, it takes a certain special skill set. I like to joke that it took me longer to attain my CCIM than for me to get my master's degree. I actually took my first CCIM class in 2007, and I didn't get my designation until almost 9.5 years later. So it's just a process that you have to go through to kind of prove to yourself that you can do this and you really want to commit to it.
I think all education is way more valuable if you can relate it to some practical experience you've had. Do you agree, Helen?
Absolutely. I just remember the first time I took that class, the intro class, and I took a 101, and that's where you learn all the spreadsheets, the formulas, and the analysis. And literally right after that class, I used that and show that to my client, explain my analysis to my client, and my client was just blown away. They could not believe I could do a 10-year analysis without my assumptions. You can do pre-tax, after-tax calculation. By no means it's like absolutely accurate, 100%, right? But it can give you a really good guidance on like where this investment property is going to take you, and if it meets your return objective.
Boy, I don't know what your thoughts are, but I find there are a lot of investors that unfortunately fall in love with something, and then they really want it, so they kind of back into it, right?
Yes.
They go create assumptions that'll make it say it's going to be okay, right?
Yeah.
And they shouldn't do that.
Exactly. I always tell my clients it's all about the numbers. Don't fall in love with the property, fall in with the numbers. Yeah.
And I think the numbers only speak half of it. The other class that we don't really put a lot of emphasis on is actually called the negotiations class. And CCIM is a required class. CCIM requires you to have that. And so you can run all the numbers and the numbers look great, but at the end of the day, how do you still make a deal workable? And that's by negotiation. And a lot of times people think negotiation is, okay, I'll throw out a number, okay, you respond back with a number, and maybe we can meet in the middle. Oftentimes that is the case, but CCIM teaches you to negotiate based on an interest perspective instead of taking a position. Right, so how do you arrive at what's important to the seller and the buyer, or the landlord and the tenant?
Do you believe in win-win deals?
Win-win deals are the only way it's gonna work. If one side felt like they're being taken for a ride, or then the deal's just gonna fall apart.
Yeah. You can try to browbeat into what you feel is a win-lose, but if you don't find out first what the other person's objectives are, right? It makes it very, very tough to come up with something that can work for both of you.
Yeah, absolutely. Yeah, we usually start off with a checklist of 10 to 12 items, and really, of the 10 to 12 items, maybe 3 or 4 are important to any one party. So you have to figure out, how do I get rid of all the stuff that's not necessarily important to me, but that's a part of your negotiation tactic.
And also from a practical standpoint of if you need to compromise, you need to know what you can let go of that's not too critical to your deal, right?
Right. Yeah. Every deal you have to compromise, just like anything in life.
Like anything in life. We'll be back a moment with Helen Chong and Tim Tran talking about their practical experience in the world of commercial real estate. So stay with us here on Real Estate Radio Power Investing.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
We're pleased to have in studio today Helen Chong and Tim Tran, who are both experienced real estate commercial brokers and investors, which is very important. It's great to have folks that know how to list or help a buyer with a deal, but it's even better when they're investors themselves, because when you got your skin in the game, it's amazing how much you learn, right?
Absolutely. I mean, we can actually speak their language and understanding what their objective is, and then help them make money, and that's the most important thing. Yep.
And if you've been both an investor as a buyer and a seller, then that helps you too, especially in negotiations like you were talking about before, Tim.
Yeah, absolutely. It's a different perspective, and you're able to put yourself in their shoes and find out what's important to them. And when you have your own skin in the game, it makes you look at everything, with a lot more fine-tooth detail.
Let's talk a little bit about finding deals. In this hot market, and most good markets are hot, in my opinion, across the country. It's very hard to find deals, and I think we both have experienced folks that are overpaying because they just got to have a deal, right? And when they should be walking away.
Yep.
So what can you two tell our listeners and audience about what do you think some of the approaches in finding out what kind of asset class, what kind of market, submarket they should be in, how to go find a deal, I'll just leave it at that. Okay.
Yeah, I mean, this is like a common question our clients ask. It's like, where should we go? It's too expensive over here in the Bay Area. But we actually do some market research, market study. You can look at some sub-markets, just like what you were saying, that outside of, let's say, San Francisco, maybe an hour drive, somewhere between here and Sacramento. People all know about San Francisco, Oakland, and Sacramento, but they don't look at things in between these two big cities. And then you look at the economy of each city. For example, I've been mentioning a lot about Stockton. Stockton is interesting. A few years ago, everybody was trying to running away from Stockton, but then now,
and a few years before that, they were all running to it.
Yes, yes, that's true.
My good friend John Schaub in Florida, who's been in the home business for a long time, asks folks frequently. If they're new to real estate, says, do you like roller coasters? Yeah. Says, you're going to love real estate. Right?
Yes. But you also need to look at what is your objective. Some people like building equity, and some people need cash flow. So you really need to look at what you're looking for. In San Jose or Silicon Valley, it's great for building equity. We have clients who bought here and immediately get $1 million equity, or like a few months later or a year later. But then the cash flow wise might be a little tight, but still it is a very good investment. And then we have other clients who buy, let's just say Stockton again, but they have great cash flow. Maybe they don't build the equity as fast, but then they needed the cash flow for every month. So I think they
got to first of all figure out what their goals are, right?
Exactly. Yeah. You have to figure out what your goal is, and then some people say, oh, this is too risky to be in the submarket, and it's a lot more. Yeah, it's a lot more safer in Silicon Valley. So just
at least when things are going up.
Yeah.
I'm watching cycle number 5, so I've seen the safe times, I've seen the not so safe times, and it's we'd all like to feel like we've got the magic formula of knowing when those changes in cycle are, but it's really tough. I was extremely confident that we were going to crash before the crash. I just didn't know when. I didn't quite understand why, but okay. We'll be back in a moment with Helen Chong and Tim Tran talking about commercial real estate, how to find deals, and how to manage them and execute deals. So stay with us here on Real Estate Radio Power Investing, and we'll be back in just a moment.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
We're pleased to have in studio today Tim Tran and Helen Chong, who are experienced commercial real estate, not only brokers, but also investors, and both officers in the Northern California chapter of CCIM. Let's talk a little bit more about how you analyze a deal. So yes, it's hard to find a deal. You got to figure out what your objectives are. whether it's cash flow or appreciation, what asset class you want, so forth. No matter what you get, though, you've got to run the numbers, right? You got to figure out what the number. You got to analyze it from a numerical perspective. And in my opinion, that's one reason why techies do pretty well as real estate investors, right? Because they tend to be more data centric and less emotion in it, right?
Absolutely.
And now, I got to say that I think we take a bad rap sometimes, because even engineers have emotion once in a while. But well, they're certainly good at analyzing. So tell us how you go about analyzing a deal.
So well, we definitely utilize the CCIM analysis models. The way we do it either.
And tell us what that is.
So the CCIM analysis model, we basically look at we put together APOT. We call it
annual property operating data.
Yes.
And from that, you generate it's basically a cash flow model.
Mm-hmm.
Yep.
Yeah.
Okay.
So we look at the 10-year or 5-year cash flow model every month, and then we look at the sale model, basically do some assumptions, and then see what we can sell it for in 10 years or 5 years, and then from there we can calculate the IRR. So this is just like a very broad basis, and then there's like 5 tabs on our spreadsheet model, and then from there we also can calculate like what can this property support in terms of loan if you do need a loan, because we have to, as you know, lender, when they underwrite it, they have to meet that debt service coverage ratio. So from this spreadsheet, we can pretty much tell our clients, okay, if you are interested in this property, you probably should expect a certain amount of down payment, and then through these 10 years, we look at the pro forma. What is the potential rental income that you can get, and then we calculate after 10 years, and 11th year we do the sale model. So our clients sometimes would tell us like, we want to meet about 7% or 10%, or some clients they do want to meet 20% investment objective. So from this, we can clearly and very easily look at that, and it's like, okay, this is the product that you can actually meet your investment objective, or this is a product that let's just throw it out. It doesn't meet it, and let's just find another property right away.
Okay. Tell us a little bit about some of the different assumptions that you have to determine.
So this assumption would be like the the rental income escalation. How many percent it can increase per year. Let's say the property right now is way undervalued. The market rent should be $2,000, but they're only getting $1,000. So your first 2-3 years, you probably try to catch up to the market rent. So the assumption will be a little higher, and then afterwards you can stabilize at, like, let's say 3%, 4%, or 5%. And then of course there's also expense.
They sound like Silicon Valley numbers.
Engineering numbers.
No, I mean the high percentage of rent increase. Yeah. Some markets be real happy with 1.5.
I know, but believe it or not, there are current owners, they just never raise rents, right? So when you pick it up and you just raise,
then you guys figure out if it's in rent control area and all that stuff.
Exactly.
Right? Yep.
And that's another factor that we have to look into, if it's under rent control or not.
If it's residential.
Yeah.
Mm-hmm.
No. And then we also look at the expense assumption, and usually we do about 3% expense assumption. And then we also do pre-tax and post-tax. So we look at the tax bracket of that client, and also depreciation. So there are a lot of different factors we put into the spreadsheets to calculate the numbers.
And Tim, in non-multifam part of commercial, such as say industrial office, we have to go even more extensively sometimes and trying to come up with a probability of whether or not a longer term lease is going to renew, how long it's going to be vacant, what will be the new lease rate, and do that for every tenant, right?
That's right. Other commercial properties, that's, for example, office or industrial properties, your tenant type is important. If you've got a mom and pop's renting, they're gonna have a certain risk versus, let's say, a national tenant. So you factor that all in, and then try to come up with some sort of a best guess analysis of how you think this investment is going to go if you were to rent to this particular tenant. In terms of how do you calculate that, it's almost the same. You get your income, you minus your expense, you got your NOI, but the risk factor is a little different in how you view it.
But in the end, three people might have four different opinions about how that is. So in the end, it's really important to have the experience and people on your team, people that you're working with who have that experience to be able to make good assumptions, right? Because if you have all worst case assumptions, you'd never buy anything.
Yeah.
And if you have all best case assumptions, it's going to fail because you'll never live up to what it says, right? So it's a real delicate balance, isn't it?
It is.
That's what's great about this analysis. You can do two different assumptions, a little bit more conservative and a little bit more aggressive, and then you can find, as a matter of fact, our sell assumption, we do have three different ones. It's like, what happens if your cap rate, when you're selling, the cap rate is low? What happens if your cap rate is in the middle or is high? So you have three numbers that you can compare. So you have the worst case scenarios to the best case scenario.
That's probably the toughest one, isn't it? Is try to figure out in 5 to 10 years, what's the cap rate going to be? What's the market going to be like, right?
Exactly.
Yeah.
Is it going to be in a downturn? Is it going to have been down and come back up? Is it going to stay flat? And of course, that can wiggle your IRR number all over the place, right?
Absolutely.
So I find for most of our investors, they kind of focus on, all right, I think these guys are pretty sharp, and I think I can bank on this cash flow number, and I hope that the exit cap and value is right, and if so, that'll be a nice bump. But that's more of a gamble, right? Do you agree?
Yes. I think that is just like, hey, if you do intend to sell in 5 years or 10 years, or if you change your strategy, so you have to look at different exit strategies for sure.
Okay. So we'll be back in just a moment with Helen and Tim here for a little wrap up, a little summary about some of the things that we've talked about today on about commercial real estate investing, and very interesting segment here on analysis. So stay with us on Real Estate Radio Power Investing. We'll be right back.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Well, it's been great having Tim Tran and Helen Chong on with us today, both real estate commercial brokers and investors and officers in Northern California CCIM. And we've been talking about finding deals and being careful about not just taking something because you fall in love with it, and doing a really good analysis, and it's all in the numbers. So Helen and Tim, where do you think we are in this market cycle? I think there are a lot of folks that thought 5 years ago we'd be done in this cycle by now, and here it is. It's keep looking over our shoulder and we keep kicking the can down the road. It's how much longer do you think we have on this expansion before it comes to the train station?
It's because like almost every year, just like what you're saying, the past 5 years, every year was like, the interest rate is going to go up, and the interest rate is going to go up, and then even economists have said that like by the end of the year it's going to hit 5%, and I don't know how many times we've said that, and now it's like probably the fifth year, and truthfully, I really think that the interest rate is going to go up. But
historically, on the numbers that I've seen, interest rates going up don't kill the market.
Exactly.
It's more of a perception, right?
Yes, yes. And I mean, if you compare to in the 80s, we used to pay 18% interest rate. Right now, we're 4-5% interest. It's nothing. It's free money.
Half of what it was when I started full time in this business.
Exactly. So mainly in the Bay Area, though, and the Silicon Valley, you just see such strong job growth and such strong employment. We keep talking about we are 100,000 units short in the whole Bay Area. The demand just cannot, the supply just cannot keep up with the demand. So in terms of like a pricing, because we work on residential, single family, 1 to 4 units as well, the competition is so tough. People would rather buy instead of renting because the rent has gone up so much. So might as well have a stabilized mortgage payment every single year. I feel like the market condition hopefully is going to soften up a little bit. Doesn't go as crazy, but I think it's going to stabilize. It's going to continue to grow, but it's just going to be a lot more slower.
Tim, you want to add anything in the kind of the non-multifam commercial arena?
Yeah, absolutely. So I think in the commercial world, it's a lagger. So what's going to happen in the stock market and residential is going to follow by commercial. So in the stock market, there's certainly a lot of volatility right now. In the residential side, there's more demand than the supply. So we don't really see the market, quote unquote, crashing anytime soon. If anything, there's a lot of volatility, and people are kind of deciding how the market is going to react in 2 to 3 years. At this time, it's really unknown in terms of how the Trump tax plan will help or hurt investors.
Yep. But on the surface, it doesn't look like it's going to be, looks like it's going to be okay. I think most of my advisors say keep going like you are. All right, we're going to leave it at that. Thanks so much to Tim Tran and Helen Chong for being on today and give us their insights. Go to TomWilsonProperties.com to sign up for our newsletter and give you access to commercial syndication deals. And Tim and Helen will be at Baycom this coming March 22nd in Santa Clara. So go to baycom.club and look that up. And remember, the only thing that matters is what you do next. Thanks for being with us.